this was kind of expected, but analysts didn't know that it will come in this quarter because the scheme was in the making for quite some time. And what the positives from this would emerge in next 3 years onwards, but they have taken the provision now. So, which is a good thing, I would say, that it's out of the way. We yet to hear from the management as to how much more can come. But if this is what it is, overall, then I think it is good to get it out of the way.
Rakesh, if I can come in here, Sajid here. They have taken this impairment especially for Port Talbot, which is the UK assets, but they haven't mentioned anything about the mainland European assets which are there, where they are looking for some kind of help coming from the Dutch government. Do you see that the next round of restructuring, which will be for the mainland Europe assets, will see some kind of provisioning coming for those assets as well?
It's quite possible because they would be trying to do a similar deal with the Dutch government also, and that is what they've indicated to. So there could be further write-downs which can come in for the European operations. But see, as I said, that these are good long-term initiatives and will make European operations sustainable. So I think market would discount this. There won't be too much of reaction to these kind of provisions.
How do you see? You said that it came as a surprise because you didn't expect it in the second quarter. Were you expecting this by March quarter or coming in at the end of the year, and that's why it could be a surprise for the street as well?
Yeah, I mean, timing was a little bit of a surprise, but quantum is not. And from an overall perspective, it doesn't change anything because the street was not really expecting that high value for European assets. So these provisions are just a confirmation that, the valuation for European assets are much lower than what is in the book.
Rakesh, Alex here. I think the attention is gone on this impairment and the implications for the P&L, but then we've not really spoken about the earnings. What did you make of the numbers that were reported on the operational side?
So that is where I think the major, pain is. The Indian operations, this time they have clubbed Tata Steel long product, numbers into the standalone entity. And long product didn't really do that well. So there's a minor miss on the, Indian operations. But European operations, both UK and Netherlands, are making, deep losses. And unfortunately, the situation has worsened in Q3 because coking coal has jumped from $230 to $350, and even iron ore is up to $121 from around 100-ish. So costs have gone up and steel prices are not moving, demand is weak. So European operations are going to bleed further. And so overall, I think, things are looking a little bit bleak for Tata Steel from an earnings point of view. Not just the, lower numbers this quarter, but even Q3 and Q4 are looking weak. So consensus estimates would have to be cut. The last I checked, they need at least a 20-25% cut at the EBITDA level for FY24.
Right. So overall, another question I have from an EPS perspective, Rakesh, is from a second quarter of FY23 when the EPS was around 1.24. This quarter, it's gone down to a negative 5.07. Now, taking this into consideration, and as you mentioned that the analysts were not, probably expecting it in this quarter, how are you expecting the stock to react, number one, in terms of open? And two, what would you advise investors to do with the stock?
So, see, analysts would be looking at, a cleaner balance sheet and numbers for FY25 while giving their target prices. And as you're mentioning that the stock has also corrected from its recent peak. But given the outlook which I portrayed is negative, I think there's further downside. So maybe there's a knee-jerk reaction today. But overall, I think it can retest the 100 rupee level where it was stable for quite some time.